How does a future pension affect the Roth versus traditional calculation? The pension essentially puts me in a higher tax bracket at retirement.
Man, that's a great question, and not one that people often think about, because the general line of thinking is that, okay, right now, if you're in a higher income situation, you may want to take advantage of pre-tax contributions, build up pre-tax assets, because there's a good chance later in life you'll have the ability to convert some of those assets to Roth at lower tax brackets. And then even as you get into like required minimum distributions and that sort of thing, if you need to pull off of your Roth assets to supplement lifestyle, you can do that and control your tax situation. But Soul Food brings up a great question here. What if I'm going to have a pension? And what if when I exit the workforce at 55, 60, 65, I'm going to have some sort of guaranteed income stream coming in? Well, that idea of me being able to convert assets later on in lower tax brackets may not be there. What if I'm someone, we have people in the chat all the time that say this, hey, you think that when you retire, you're going to be in a lower tax bracket, but my experience is when I retire, because I did such a good job saving, I'm still in higher tax brackets. So there are people who do have that reality. So when that's the case, when that's the scenario, Brian, should you rethink how you do Roth versus traditional, or are current day tax savings still super, super valuable and you take advantage of it while you can, because that's what makes the most sense in the present time?
Well, I love this because this is actually a great kind of thought exercise. When I talk about do a personal financial triage on exactly where you are with your finances, we all know that finance is going to be personal, hence personal finance. And for somebody who does have a pension, a lot of times when you have a job that offers you a very lucrative pension, your current income might be lower than if you were in a job that just offered the traditional defined contribution, not the defined benefit, because that's always the trade-off, is because the defined contribution, like your 401ks, your employer is going to give you a match and then you have to fund it. But with a pension, that's a defined benefit. They usually, because there's a premium on that, you might have a little bit lower income. So it goes through the exact same, filter of if your income is lower now than it's going to be in the future, then obviously a Roth is outstanding, because a Roth, if you think about why do we love Roth? You don't get a current tax deduction, you get tax-free growth, though. That's the opportunity that you get with Roth contributions. So it makes complete sense. Somebody who has lower income now because they're in a very generous employer plan with a pension or something like that, but they're going to have much higher income in retirement because not only are they going to have their retirement savings, but they're going to have this pension, they're going to have Social Security, you're going to start stacking up all these things. And so you're going to be a higher tax rate. By all means, you're never going to get the Roth conversion opportunity that you see a lot of people. However, there's a lot of people, high incomes now, you're in a defined contribution plan, and you do think you're going to be part of maybe the FIRE movement or FINE movement, and you're going to leave the workforce at 55. You're not going to start making required minimum distributions until your mid-70s. There is going to be a drop-off of your earned income. You're not going to have any other cash flow. You're going to have a 3-bucket strategy that's completely diversified, so you're going to be able to legally manipulate how your taxes work. By that situation, if you're in a high tax bracket right now, but in a much lower in retirement, we want to go ahead and take advantage of traditional, because the tax deduction now is much more valuable than it will be in the future when you likely can manipulate those tax rates easily. So Soul Food, I think that you're thinking about this right in the fact that, if your pension is going to drive your taxes up in retirement, but maybe you're in a lower tax rate right now, and you also have decades of tax-free growth, all those things are checks into the positive for why Roth contributions are so valuable right now.
The only other thing I'd throw in there is, let's assume that you've projected this out and you think that you'll always be in the same tax bracket. Maybe you're in this working tax bracket, and then when you retire, you're going to be in the same tax bracket. Okay, well, if there's not that arbitrage, which way do I lean? I still think Roth makes a lot of sense, because not only can Roth dollars grow tax-free for your entire life without being subject to required minimum distributions at age 73 or age 75, they can also grow tax-free for the first 10 years of your beneficiary's life. So it is a long timeline where if you can justify Roth and you're not walking away from a substantial tax benefit today to do so, I think Roth is great.
One final just word of caution, though. Pensions, I know a lot of employers, you don't see as many pensions. A lot of governments have pensions. And even governments have pensions because they were so underfunded for so long, they've changed the vesting for a lot of pensions from like 5 years to now a lot of them have gone to where they might take 10 years to qualify. So just pay attention to what the vesting is on your plan, because you don't really have anything until you know you've locked in some of those benefits. So read the fine print too.